Imagine waking up tomorrow to discover that the money in your bank account isn't really yours. It exists only because someone somewhere took a loan. And if all loans were magically paid off today, the global money supply would collapse to almost zero. Strange, right? But here's the real mystery. The people who control this system, the central banks, didn't just inherit the rules of money. They quietly rewrite those rules whenever the system begins to wobble. Sometimes they do it openly. Most of the time, they do it silently, through policies so complex that even trained economists misunderstand them. Today, we are going to uncover how central banks change the way money is created, why it matters, and what those changes hint about the future we're heading toward. This is not conspiracy. This is not speculation. This is simply the story of money, told from the inside. Chapter 1, Setting the Stage, a System Built on Confidence. Before we dive deep, let's zoom out. The modern economy runs on a strange formula. Money conquers debt. Debt yearns growth. Growth yearns stability. Break one layer, and the entire structure shakes. But it wasn't always like this. The gold standard era, the rulebook of scarcity. For hundreds of years, money was linked to gold. You could trade a paper note for physical metal. This meant governments couldn't simply create money whenever they wanted. Gold acted like a strict parent, and it told nations, you can't spend more than you earn. But central banks hated this limitation. Governments hated it even more. Because wars, infrastructure, modernization, and political promises required money, and gold couldn't keep up. A breaking point was inevitable, and it came. Origins when central banks learned to bend reality. The rise of the Federal Reserve, 1913. When the Fed was born, it wasn't just another institution. It was a blueprint, soon copied by central banks around the world. Its purpose? Officially, maintain financial stability. Unofficially, give the government a controlled way to expand money when needed. Still, gold was a problem. The Fed had power, but only as much as gold allowed. The Great Depression, 1930s. Banks collapsed. People demanded gold in exchange for money. Gold reserves dried up. System fueled by cheap debt suddenly faced expensive debt, and predictable pain followed. Mortgage crisis, bank failures, corporate bankruptcies. Consumer spending collapses. Central banks were caught in a game of contradictions. Create too much money, inflation. Create too little, recession. But the biggest twist? Money creation itself had changed. Chapter 5, pull out how money creation actually works now. Most people think central banks print money. They don't, not directly. Commercial banks create over 90% of all money.
Here's the formula.
1. You take a loan. 2. The bank types numbers into your account. 3. That becomes new money. It didn't exist before. It isn't taken from deposits. It's simply created. But here's the secret twist. Central banks control how much banks can create by adjusting interest rates, reserve requirements, capital ratios, liquidity rules, asset purchase programs. These rules decide how much debt the world can absorb, and therefore how much money exists. This means central banks quietly rewrite the system by changing what banks are allowed to lend, changing what counts as capital, changing the value of assets, changing how governments borrow, changing how markets behave. It is a silent rewiring of the global economy, and most people never notice. Chapter 6, Failed Fixes. Why every solution creates a new problem. Every rewrite comes with a cost. After QE, asset bubbles. Stock markets soared while wages stagnated. After low interest rates, debt addiction. Countries, companies, and individuals borrowed far more than they could ever repay. After high interest rates, cracks in the system. Banks failed. Housing markets slowed. Companies collapsed. Each fix solves today's crisis, but seeds tomorrow's. Chapter 7, Modern Parallels. The New Playbook of Money. Look at the data. Global debt is now over $300 trillion. The U.S. creates more debt every 100 days than it did in the entire 20th century. More than 70% of all dollars in existence were created after 2008. Central banks globally printed $10 trillion in 2 years during the pandemic. Inflation reached levels not seen in 40 years. Patterns are repeating. Too much credit, crisis, central bank, rescue, bigger system, bigger bubble, bigger crisis. The rulebook of money creation is no longer fixed. It evolves whenever the system trembles. And the next rewrite may be the biggest in history. Some central banks are already preparing for it. CBDCs, central bank digital currencies, a system where central banks won't just influence money creation, they will directly control it. Final chapter. Takeaways, warning, call to action. 3 clear takeaways. 1. Money is not a fixed system. It's a set of rules rewritten whenever the system cracks. Central banks adjust those rules quietly and most people never know. 2. Debt is the money supply. When debt grows, money grows. When debt crashes, economies crash.